This is Market Call. Welcome to the show. We have David Burrows for the next hour, President and Chief Investment Strategist at Barometer Capital Management. He's taking your questions on North American large caps. Here are the ways to reach us. If you have a question for David, the toll-free number, the email address, you've got the Twitter handle at Market Call. Take your pick and we'll pass it along. Good to see you. How are you?
Great to be here, Mark.
So, the last time we spoke, you thought we were in a nice secular bull market. Has anything changed?
I think if anything has changed, the markers of a bull market have continued to get stronger. So I think that we have moved from a world between 2000 and 2012, which was where equities were being revalued lower versus alternatives like fixed income and real estate. Last year was the first year in 13 years where the multiple that investors paid for earnings expanded. In the 1990s, the multiple for the market expanded in 8 out of 10 years. Once that begins, it tends to go on for a long time. So I think very clearly money is rotating from other asset classes back to the equity asset class. And valuations and dividend payouts could support, I think, several years of fairly consistent gains.
So when you say multiples, are you talking about the S&P 500, for example?
Yeah.
And that could get up to 23, 24, maybe?
Well, look, the toughest time for investors is when earnings are growing at X, say 8 or 9% as they are currently, but the market's going up 20, and they say, how does that compute? In the 90s, the way it computed was earnings grew, but the multiple that investors were willing to pay for those earnings expanded as they became more confident. And I think we've come from a world where there's very little confidence in equity markets. And as money rotates back towards equities, the multiple investors will pay, I think, is likely to rise, so long as earnings continue to grow consistently, and so long as the competition interest rates remain low. And I don't think there's any sign that that's about to change. So there are some very clear themes in specific sectors. I think that gives some outsized opportunities.
One of the themes you've talked about is energy infrastructure. What are some of the other ones?
So we're big believers that the front end of the baby boom needs income replacement. And so energy infrastructure happens to be a sector that's seeing volume growth and is very predictable, and we're getting good cash flow growth and dividend growth. But if you take large cap stocks as a whole, specifically in developed markets, consumer-led economies, for 12 years, they were nowhere. The cash flow quadrupled in the S&P from 2000 to 2012, but the multiple contracted. So there's a lot of large cap companies with very strong cash flow generation, very strong dividend growth, like, for instance, some of the old tech, like media, like some of the consumer sectors that have those characteristics that could support a big increase. The long-term average over the last 100 years is for companies to pay out about 50% of their earnings in dividends. The S&P 500 today is paying about 34% of their earnings out. That payout ratio is rising slowly. Earnings are rising, cash is plentiful. So I think we could see dividend growth for a long time, and that's attractive to somebody whose comparison is a 2.5% 10-year bond.
Right. And just lastly here before a break, what kind of money flows are you seeing? Where's the rotation occurring in terms of where money is going?
Well, it's a very interesting market because through the 90s, the correlation stock to stock and sector to sector became lower and lower, meaning certain industries really started to outpace. And the same thing's happening. Last week, we hit the lowest correlations, sector to sector and market to market, in the last 5 years. And so there's from very specific leadership, technology is leadership, energy is leadership, industrials are leadership, specific parts like auto, for instance, transportation is leadership, chemicals are leadership. Mm-hmm. Those are all seeing net inflows. We're seeing expanding breadth, meaning more and more stocks within those groups are performing well. That isn't significantly different than it has been through the course of this year. And the other hard thing for investors to do is to stay with something that's working, because we're always worried about what's the bogey around the corner.
Right.
And at this point, I think that really that's what you have to focus on, staying in the things that are working.
Let your winners run, right?
That's right.
Okay. Let's take a break here with David. We've got a good table setter there, a nice overview on the markets, and David will drill down on your questions on stocks after this.